measurement to get smaller than the previous from peak to trough, and you're using your absolute high to absolute low. So yes, they need to be higher. Can we buy a low cheat after base one? I'm not sure what that means, but it's on page 126, so it's right here. So I think I understand what you're saying. Let me get a draw a trend line. I think you're talking about right here. And why is that yellow like that? How do I change that? Oh, there you go. All right. So yeah, right here. So yeah, that is a low cheat. And I would say that that's a very good eye of seeing that. And yes, that's a buy point. Absolutely a buy point. And you see, it's much lower within the base. Now you do have a lot of overhead to contend with on the left side, so the chances of this working are less. And I talked about this, David and I talked about this before, where you're what the cheat, the low cheat, the handle, which is a higher probability. The cheat and the handle are about the same. The low cheat might be a little bit less. You have some, especially if you have some overhead to contend with. And you see how it comes up, and then it has to come back down and sort of reset and go through that whole process again. That's the ringing of the towel. That is the supply being digested until finally it's all taken out, and now the stock can move freely. But yes, that is indeed a buy point there. Let me just get that out of there. Let's see.
And Mark, the question does, if I understood it right, does the VCP have to be going up? Um,
Higher lows with to
Higher
make.
lows,
Yeah.
but lots of times you'll see bases that just go sideways, so you won't get higher lows, but you'll get that tightening or even the drifting off, where they're actually making just slightly lows, like yeah, like you pointed out in that that low cheat that's not labeled, because yeah, I think a proper consolidation is sideways to drifting down. You don't. It's a very minor. It's a fairly important point, but something to watch out for. And maybe we can find another example where you have something that's wedging up, even though it's tightening up, it's wedging up, and that's, to me, it's, you got to be a little bit careful of that.
Yeah, we do have a good example, and I'll find it later. I think there's a question on Dick's Sporting Goods on why not to buy earlier in the base, and it has a wedging right side off of guidance of the company issuing upside guidance. So we'll get to that, and we can let you talk about that. But this is specifically on the VCP. Dave mentioned that after he confirmed VCP on the right side, he will compare it to the left side to see if it is in the upper half of the chart. Can he elaborate on that? And does that mean that the price should be near the 52-week high?
Uh, yes, I mean, but I mean, then this would, I mean, this would eliminate low cheats. I think
Right.
the stronger, the stronger the position, or what the closer the stock is to its old high. So if you're looking at even the Central Garden and Pet, that you can see it's in the upper half of that entire base that looks like it's gone from 16 all the way to 12 and back up to close to 17. Um, yeah, that to me is a good solid base, because you actually have very, very little overhead from that point. Um, but as
Right.
as you mentioned earlier, if you're going for a low cheat, you do have overhead, and it could come up against resistance and pull back and shake you out. So to me, this is the best buy point, especially on this chart. Same
And
thing, yeah.
yeah, and sometimes you have a low cheat that doesn't have a lot of overhead. The overhead's a ways back, and just the way the price set up. Here is where this is technically. I'm going to show you here, and we're really going to go off the reservation here. But right here, that's a low cheat. That's a buy point. Now, again, that is a buy point that is an expert buy point. You have to realize there's definitely a lower probability of this working. When I say working, I mean taking off before it challenges your stop, or you can see here it runs up a bit, but then comes down here. See, that's where it meets this supply. And then if you were to what we talked about before, you just draw a line like right across here, and you start to see where the majority. And I don't know how to move that line actually. Hold on, I'm going to clear that and do it again. Hold on a second. Let's take that. And so we just draw this line right across here. And you see the majority of the price action has happened right around that 53, 52 level, give or take. That's where the majority of the price actions happen through this entire base. So when we finally tighten up right here, just above it, we tighten up right, that's where that specific entry point is. That's what specific entry point analysis is. Let me explain to you real quick why did I come up with this term, specific entry point analysis, or this technique, and try to get so pinpoint on these buy points. The reason was poverty. Okay, I started off very poor, and I had to two things. I had to make money quickly, and I had to make sure that I could compound it very rapidly. So I realized, I did the math, and I said, okay, I've got a few grand here. To make this into something worthwhile, I got to compound the heck out of this money. So I wanted to figure out how I can minimize my downtime and constantly be rolling into stocks that were on the move, and to know immediately if I was right or wrong as quickly as possible. I wanted to know if I was wrong, good, stop me out that day if I'm wrong, because then I can move on to something else. So I started to really study and to figure out when these stocks really started moving fast and in earnest, and that's what led to these very specific buy points. And when I first approached Dave to write the forward to my book, he wasn't interested, and I don't think he believed that anybody wrote a book that was even, could be even near as good as O'Neill's book. I had a hard time believing that myself, because O'Neill's book is so wonderful. But then I sent him my manuscript, and he said, wow, this is like, the next level of O'Neill. It's so forensic. And I think, Dave, you said it's the book I always wanted to write. He said, now I don't have to write one. You wrote it.
Right. Exactly.
So, but this is sort of, and I'm sure, somewhere down the line, someone's going to write a book and going to take this work to another level. I'm not sure how, because I think we've got it down to the exact buy point here. I'm sure that there's going to be advancements, and somebody else will further my work. So anyway, that's, in the VCP, I came up with this simply to teach people, because I found so many people were misdiagnosing stocks. We were saying, is this a coupled handle? Is this a correct base? Is this a right pivot? And most of the time, no, it was nowhere close. Even after VCP, a lot of people get it wrong, but a lot more people get it right since the VCP concept. This has, for some reason, has made it, brought it to life, where people can now see it better, and they go through that count, and it just makes it easier to find for whatever reason. I guess it quantifies it a bit more. Let's see. So page 130. I know we get a lot of these questions, are stocks buyable earlier? September 3rd over here. So I would say no. I that's a little too sloppy for me. I liked where it tightened up here. So I would say no, that's not ready to buy there. Let's see. So on 130, same page, should I set the initial stop loss at the last T before the pivot point, or should I use a 7 or 8% stop if it drops below that point? So the last T is right here, and that would be basically the same thing, because that low is 8% from the breakout. So even if you paid 1% above that, it would be a 9% stop. So Dave, this is a good time to talk about, and I'll give my word on it too. But so when you get into the stock like this situation here, Netflix, let's just say this is, this pullback is 10% or 12%. Are you using the low and the pivot as your stop, or you defaulting just to a mathematical number or dollar amount? How are you approaching that?
It all depends. It all depends on that base. If that base is really, really tight, and let's say that low was 46 and the buy point was 48, I would actually use at least to start selling part of it at 46. I don't have to wait till it gets to 8%. So it depends on the tightness of the base that I'm buying out of, and then if not, then if there isn't a shorter sell point, then I do use that 8%.
Right. So there's a few things to point out here. One is you don't have to sell all at one price. Now we're going to get into, again, a lot of these questions are all going to be answered later, but we'll answer them now, and then we'll have curriculum on them later on during risk management. So you don't have to sell all at one price. Right. There's something that I call staggered stops or bracketed stops. So sometimes what I'll do is I'll get into a stock and say the low is a clear cut out. Maybe it's the low in the base or the low in the pivot, but it's 10% away. Well, then I might sell, and my goal is to keep this the loss limited to, let's say, 8%. So you've got a 10% clear cut out. So now if I sell half at 6% and I use that other technical level at 10% as my out, that's 16% divided by 2 would be 8%, right? Half and half of the positions. I would still accomplish getting that 8% loss, but I would give the stock a little more room on half the position below the 10% stop. So I can give it the 10% stop. And that's when you blend the stops or use what I call staggered stops. That's one way. The key is that you want to the stop, and I always talk about risk first, backing into risk. You're backing into the risk, right? You're selecting stocks based on the technicals being tight enough where, again, they give you that technical out. And if they don't, if you're enamored by the stock and maybe the technicals are a little too volatile for your risk appetite, well, then you have to switch over to a mathematical stop, and you just say, look, I'm out at 6%, or even a dollar stop. For many years, when I first started trading, I used a dollar stop. I would just say I'm going to risk. I'd go in and I'd come up with a dollar amount that I was comfortable with, and that I basically had to just trade what I could stomach, because I didn't want to get an ulcer from trading. So you could say, well, the percentage is 8%, and but you have $1 million portfolio and you're taking 25% positions, and you're talking about a $20,000 loss. Well, some people they'll end up with sickness if they take those type of losses. And you get stopped out 4 or 5 times in a row and you're down 100 grand. Some people will get very ill from that. So you have to figure out what your risk tolerance is too. So that's just elaborating on that a little bit. We're going to get into that more anyway. Is the handle or the pivot, should it always be single digit contraction? Now, I prefer a single digit pivot for the reasons that I just said. But there are times where it might be 10 or 12% or even a little bit more. But generally speaking, if you start getting into a 15% handle, that's not really a handle. That's sort of getting into the depth of a base. How do you feel about that, Dave?
I'd say the tighter the better. If that contraction is 1% or it just flat lines, that's better than a 10% pullback in that consolidation.
Right. So now, the question is on 139, the first VCP setup in stage 2. Not sure how that is stage 2, if it still looks like it's moving sideways. Okay, well, it can look whatever it wants, but the fact is it meets the 8 criteria. See, that you don't have to guess. I gave you 8 criteria. If it meets the 8 criteria, it's in a stage 2 uptrend, and that's all you need to know. And then from there, you start looking for a base. Let's see here. So what's the minimum pullback allowed in a base? All right. So the maximum, I'm sorry, the maximum pullback. So we talked about this before. Dave said anything over 50% he's not interested in. I'm pretty much the same. Maybe, like I said, in a big bear market, you see a lot of stocks are having those big declines. You might get those big declines like, well, this isn't really that large, but let's just say this decline right here was 50%. Well, if the market was a big bear market and a lot of stocks, maybe the biotech sector, all the stocks had big 50% declines, I might entertain this, but a big decline is going to need a big right side, and you're going to need to see some symmetry. And usually, you're going to get multiple tightenings. You're going to have to go through that wringing of the towel. There's a lot of supply, so you're going to have to wring that towel out, like we talked about before. You're going to have to wring out that towel. I know we had some questions about what these little abbreviations mean on this slide. So trapped buyers, we talked about the trapped buyers on the left side, right? Supply. And then bottom fishers, buying off the lows. And then up here, as you come up the right side, you have profit taking and loss cutting. So you have profit taking from the bottom fishers that are at a quick profit. And then you have loss cutting from the people that were trapped buyers, and it's coming back near their price, and they're maybe getting even. And then that same thing happens over and over, just on a smaller level. That's why you're getting smaller pullbacks, and it's lasting less time, because there's going to be, obviously, if this is a 50% decline, a lot more trapped buyers with bigger losses, and the bottom fishers are at a larger gain, right? So there's more potential for profit taking. So then when you get into the next pullback, right, you've weeded some of this out. So now you've got some people that are still trapped here, or maybe bought it here. You've got some bottom fishers here, but they're not at as large of a gain. They're not at as large of a loss. So now a little shorter time goes by, and it's shallower, and it just keeps going through that until finally the supply is out of the stock. There is no more supply. This concept of supply not coming to market is so key to understanding VCP. When you fully understand the reason behind this, you will fully grasp that this is not a technique that works because people are using it. It's not the cause, it's the effect. Okay. So it's the effect of supply and demand. It's not the cause. Once you understand that, you will know that this is timeless. And that's how you'll make a commitment to it for the rest of your life, and know that this is a technique that will work forever. And that's why it's so powerful. Let's see here. Faulty base concept. Okay, I don't like to get into looking at the wrong way to do things, or why something is faulty. I think that it's more important for you to look at charts of winners, as opposed to, well, why is this faulty? Okay, I understand there's a million reasons why a base could be faulty, but there's only a small handful of reasons why it's right. And we need to concentrate on that more than anything. I know, what page was that on anyway? 140. 143. We talked about why these were faulty. All right. One, wedging up the right side, a big decline relative to the market. I mean, 50% decline when the market's only down 10%. That tells you right there, that's not normal. So again, I just pointed out that if a whole bunch of stocks are down in an industry, or the market's down real big, you have a big bear market, well, then you can maybe cut the stock some slack and say, yes, a 50% decline, I can maybe trade that or buy that stock if it sets up. But again, as I pointed out, you need a big right side when you have such a big decline. Is that a big right side? No, it's just coming up the right side. Right. It's a wedging rally, and it fails miserably because it goes right back into that supply on the left side. I'm not going to get into too much of why something is bad. I want to focus on see and getting your eyes to see what you need to see, not what you need not to see. Let's see. So on page 144, it's the same thing though, I think. Dave commented, it doesn't have the look. I understand T signatures, but do not understand the look. Can the look be summarized? Okay, so again, I'm going to give this to you, Dave. But Dave always will say to me when we talk about stocks, I'll say, "Hey, what do you think of this?" And I'll be, "Nah, it doesn't have to look." We use that term. I use that term now. That's what he always says, but I even use that term now to say, "Does it have the look?" I think that's developed over time as you become, more skilled at this. I don't know if we can. Could we actually, determine, quantify the look, Dave?
I don't know if you can quantify it, but I think it's what it is the way you develop it is and this is what you should be spending a lot of your time on, is looking at proper bases, looking at greatest winning stocks, and just concentrating on their bases and what did they look like before they made their major moves. And I've used this example before when they teach, I guess, people at the Treasury Department to look for counterfeit bills. When somebody's counterfeiting bills, what they do is they don't have them study the counterfeits, they have them study the perfect bills, and they get that ingrained into their mind. That's what you should be doing, is getting ingrained into your mind the perfect base and those bases of the big winners, because then when you see it, you'll identify it and you'll say that looks exactly like so and so winner from 5 years ago. But when something doesn't have that look, it's a faulty base. It does not look like a great winning stock, and it's usually wedging up in the handle, or there's the volume is too big on the as the stock is correcting as it's setting up a base. I mean, there's just a ton of things that you could be looking for, but you
Right.
got to get that ingrained in your mind, what a beautiful base, a perfect base looks like before it makes a big move.
Yes, and I was hoping you would go with a counterfeit bill analogy, because it's one of my favorites ever. It's such a great a great thing to talk about on how when they look for counterfeit bills. I mean, if you know what a perfect bill looks like, then anything other than that is not a perfect bill, right? So again, this is and my book. I know I heard Bob talking about my mindset book. I talk about how to practice, how to have perfect practice, and that's a big part of the concept of my whole strategy towards life, towards anything that I try to accomplish, whether it's the shooting competitions I do, or tennis. Dave's big with tennis; he's a great tennis player. I'm looking at the best players, the best operators, and trying to figure out those few mechanics, and to master those, not going and looking at the worst players and saying, let me find out all the things that all the crappiest players do and not do those. That's ridiculous. You could never become good at anything with that with that mindset. It's a terrible mindset, and so many people go in so many things with that kind of a strategy or mindset, and they don't realize that they're just sabotaging themselves right from the beginning. And again, focus on finding the perfect setups. And a friend of mine, a good friend of mine, Jeff. Hi, Jeff. He's here today, I believe. Has been on the attending, and I just spoke with him the other day, and he asked me about a stock, and I said, look, you have the workbook. Go to the workbook, and does it look like the stocks in the workbook? See if you can find a precedent. If not, well, then it's not a great setup. There's so many setups here that I'm showing you in this workbook. There's hundreds of examples under so many conditions. Can you find even one that looks like the current stock that you're looking at? O'Neill's book has a whole bunch of charts in it, and of course, my two books have a tremendous amount of charts in them. Some that are on here also. But again, try to get that and print it into your mind what those perfect setups look like. So, do you prefer weeklies over daily? So I always look at both,
Yeah.
and there are some nuances that I will look at on a weekly. And Dave too. We look for volume markers on the weeklies. We're usually looking for big volume, maybe in the base, to see if there's big down weeks, and just looking at the quality of. And again, we're not going to be able to impart all our experience on you. We'll be able to impart our knowledge and give you and quantify a lot of things and take you to a new level of knowledge and give you a whole bunch of examples and a lot of information. But when it comes down to knowing the look and being able to go in there and forensically look at a base and see one volume bar that that's suspicious, and that's really something that I got to be careful, that takes experience. We're not going to be able to impart all that experience. Unfortunately, experience has to be earned. It happens over time. You can't force it. You can't become a great tennis player just because John McEnroe is teaching you and he tells you everything he knows in a weekend. It just isn't going to happen. You're still going to have to practice, and it's going to take years. So same thing with this. As far as weeklies and dailies, I'm always looking at both, and I know Dave is too. Um, how do you still?
I even go out to the monthlies too, just to see the big picture. I want to see every aspect, and then sometimes, and then to when I'm really even getting down into the super detail of the breakout, I'm looking at intraday charts to see if I can discover anything there. But I think you concentrate mostly on the weeklies and the dailies. That's where you should be making your most of your decision.
Yeah. I'll look at the monthlies too to get that long term perspective. But yeah, I'm looking very forensically on the dailies and the weeklies. I'm looking to see the longer term trend and the quality of the base and analyze the volume on the weekly level. But again, you want all the time frames to look good. Some people say, "Oh, take a look at this." It doesn't look good on the daily, but the weekly looks good, or vice versa. So let's just say, the daily looks great, but it's in a downtrend below the 200-day moving average. That's not something that I'm going to consider. So you have to take it all into consideration. Let's see here. Does massive volume in the drop at the beginning of the cup on the left side give you pause for concern? All right. So let's see if there's a page. Okay. The 147. Hold on. Let's get to that. All right. So I wouldn't call this massive volume to begin with, and I wouldn't call this a huge drop. But Dave, does this, and I think there's two things we should talk about. One, if you're going to see massive volume in a drop, you'd want to see it on the left side. That's
Yeah.
where it usually happens. And does this give you reason for concern? I mean, I guess if you owned it, right, if you already owned it right here, I wouldn't like to see that. But again, as far as analyzing the base, and we're looking at it as a buy candidate over here on this left side here, does that give you reason for concern to buy the stock over here?
No, and that's lots of times that happens after a stock makes a really nice move. And look at the perspective of where this has come from. This stock has had a 50% move. It's come out of 10, it's gone to 15, and then it starts pulling back. And yes, it's very natural for a stock to get hit on volume one day, a couple of days. Now, what you don't want it to do is you don't want that volume on the downside to persist. A couple days is fine. Then look what happens at the rest of the base. The rest of the base, it looks like it just really dries up. The volume really dries up. The stock tightens up, and it goes through your VCP pattern, and that's fine. So
Yeah.
1 day, 2 days is fine. It's just look at the whole base, and if it doesn't continue on, then in terms of big volume on the downside, then that's fine.
You can stay. It's still in an uptrend. It's
Yeah,
within
I
an
mean
uptrend.
everything is. Yeah, that's a beautiful base.
Yeah, it's perfect. This is perfect. Again, like I just said before, look at your stocks. You can compare them to these precedents. That's what I do. I compare the precedents. I have these precedents in my head. My head is like a Rolodex of precedents. I'm very good at. Some people said I have a photographic memory. I think I might have a photographic memory for charts, but not in life. But I was a musician all my life too. So I found that musicians can read charts pretty good, I think, because if you can read music, there's been some people have talked about that. I think Linda Bradford Rasky also talked about how musicians, she feels they can read charts well. But again, to get back to the volume, yeah, if you're going to see heavy volume and a big decline in the base, you're going to see it usually down the left side and around the lows. You'll see a lot of volatility. And that's where the volatility should be. And then as you get to that right side, that's where you want the contraction to happen. And then you want the volume to start calming down as it gets over to the pivot. Let's move on. What is a pause pivot? A pause pivot is simply a very short pause, very short pivot. So it might only be a 1 or 2 days. And yes, you can have a pause pivot. I'm not sure if we have an example of that. If I see that, I'll point that out as we go along. So another, excuse me, another page 147 question. How do you make sure the breakouts are good before I buy in terms of volume? Good close, bad close. Well, obviously you don't know the close until it closes. So the answer is you don't. You have to buy it intraday. You can extrapolate volume. So for instance, let's say in the morning, the average volume, let's say, trades 500,000 shares, and by 10:30 the stock starts breaking out, and moves above the pivot point. You buy it, and by 10:30 in the morning, the volume is 250,000 shares. It's already done half the volume in the first hour of trading. That's running at a really good pace. So you would know. So Dave, if the stock breaks out early in the day, I mean, are you going to not buy it because you don't see the volume yet?
No, I'll start a position. I'll take an initial position, especially if everything else is set up. If the base is beautiful and the earnings are there, then no, I'll go ahead and I'll start buying it. And then I might buy it, 2 or 3 times throughout the day as it progresses, if it's doing everything right.
Right. And let's see here. Page, it's okay. The page is 147. I'm not sure, maybe because of this big move here. That's the question. But how far above the breakout pivot do you say a stock is extended and should not be bought? In general, define what extended means. So I'll give you my take on it, and then we'll let Dave give you his opinion. I'm not buying more than 1 or 2% above the pivot. Virtually never. I'm either buying at the right price or I'm not buying at all. Now, if I have a big position to buy, maybe, and big is relative, but let's just say I have 5,000 shares to buy or 10,000 shares to buy, and stock starts moving, and I can only get 500 shares at the price, and then it gets away from me, well, then I end up with 500 shares. That's it. I don't chase it. And as far as extended is concerned, once you get away from the base or even the respective moving averages, like if you're a good distance from the 20-day and you go back and you look and you see that, every time the stock has been that far from the 20-day, it's pulled back. Well, that can give you an indication that it's getting extended. All right. Or the 50-day moving average. But again, if you're getting far away from the base, and the further you get away from the base quickly, that's getting extended. Now, in a breakaway move, you want to see that, but you don't want to be paying up for it. You want that to happen after you buy it. You want to buy it as it comes to the base. And then, yeah, getting extended, having a really strong move coming out is great. Dave, what's extended to you, and how far above the buy point are you buying?
When I first started in the early 80s, I think Ed O'Neill extended at that point was 10%, but the
Yep.
market seemed to move a little bit faster. And so I would say the closer you can get to that buy point, I mean, if it's 1 penny above that pivot, that's where you should be buying. I wouldn't go any more than 5%. Once it starts getting past 5%, then you start running the risk of the stock squatting or the stock pulling back and sitting on top of the base or shaking you out. So the closer absolutely is better. And if you miss it, well, look, there's thousands of stocks out there. You can also, what a lot of these stocks have been doing these days is they break out and the next day they pull right back down to the buy point and you get a second shot at it. So don't get discouraged if you start missing some of these. You can set buy stops to, if you got another job or you can't sit in front of the market all day long, you can set buy stops and sell stops and help you get into some of these positions as they're moving out.
Yeah. Question asking, what is a natural reaction? Is there any definition? Well, a natural reaction is just a pullback in the stock after it breaks out. And that can usually occurs above the breakout or just slightly below it, maybe on the first pullback. Here's a pullback that looks, it looks a little scary here. If you bought this stock, it comes out for a few days and then wham, comes right back in. Well, you don't know it's a natural reaction until you see if it can get back into new high ground relatively quickly, usually within a few days to a few weeks, usually a couple days to a couple weeks. Now, again, if this came in another few days and you get a pivot failure, the more it comes in, the more technical levels it breaks, the more the percentage decline, obviously, the more likelihood it's not natural. But usually those pullbacks are confined to pulling back above or just below the breakout. Sometimes you'll come in and you'll undercut you'll be at a small loss. But again, you want to stick with your stop. When you first trade the stock, you come up with an amount that you're going to risk and you stick with it. And now, unless the stock has a violation or gives you a profit that you're very happy with, and it makes mathematical sense to take that profit versus how much you've risked, you should be sitting with it and then allowing the stock to pull back and then see if it can get into new high ground. These are all natural reactions. One here, 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 here. These are all just the pullbacks where within a few days or so you're back into new high ground. A little pullback here, a few days back in new high ground. Little pullback, back in new high ground. See, these are all natural reactions. Now, once you understand what a natural reaction looks like, you will be able to understand what an abnormal reaction looks like. Okay, but if you want to go and study all the abnormal reactions, well, then you'll go study 9,000 different reactions, and you'll never be good at any one of them. So again, going back to my philosophy of studying the best, seeing what looks right, and then everything else other than that is wrong. That's the way to look at it. Let's see here. Okay, on page 150, 150, there are two inside bars, and you bought above the high, but many times you were waiting for more tightening. Can you give guidance on when you would put a buy stop versus wait for more tightening? How do you know the stock is ready? This is a great question. How do you know to buy here, after these few inside days versus waiting for maybe another inside day or a few more inside days? If you want, I'll give you a crack at that first, Dave. How do we know to buy here as opposed to waiting longer?
Well, you look at the whole base, and you can see that the contractions are getting smaller and smaller, and it's also forming a nice little, you can see a little cup and handle in there, and you're right below the buy point too. So if it goes through that buy point, then then you should go ahead and buy it. I mean, it's the whole picture that you're putting together to get you to that point of where, hey, there we go. The other thing too, as you pointed out, lots of times you do get inside days where there's just really very little movement between, an inside day is it trading inside the high and the low of the previous day. And you actually have two inside days in a row before that stock breaks out. And so it's a combination of a lot of different things, but how much tighter do you want that thing to get? I mean, if you
Exactly. I
wait,
mean, that's pretty tight.
yeah, I mean, if you wait any longer, then stocks don't get as that tight. So it's the whole look, and it's actually going through the buy point as it leads you to say, I'm not waiting any longer. I got to go right now.
Yeah, and again, this is where the skill comes in, and you have to take the whole picture here and see the symmetry of the base, the contractions. You're counting the contractions, right? You got your first pullback, two, three, so you got a 4T. I mean, it's perfect. It's super super tight, coming right through a level here. If you go all the way across here, you see it's only traded above that level on few rare occasion here, and less as you're getting to the right side. So this supply is diminishing over time. So the overall picture here, I mean, this is a perfect base. I mean, you don't get much better than this. If you were to use a precedent, this should be a precedent that you should be, stamping on the wall and looking for stocks that set up like this, especially off of IPO setups. Let's see here. And again, you're going to need experience over time. You're going to get good at this, and you're not going to be right all the time. You're going to do this, and there's times where you'll think it's a good base and it'll come out and it'll fail. And there's times where you'll buy a crappy base and it'll work. It's only over time that you'll start to see what works more than not, and how well a particular situation you could manage the risk, and you can manage the risk reward relationship. Um, all right, so 150, 151. What about the overhead supply, July, August? So that's talking about the same chart here. Like I just said, this is way back, and that's not a lot of overhead supply. It's only been there for a short period of time, and it's quite a ways back. It's months back. The further back the supply is, the better. And the closer you are to it is better, and the depth of the decline. So there's a number of things you have to manage, but you have to assess. But when you take a look and you draw that line right across, you see that it really hasn't traded above that level. So you're really clearing out a lot of price action when you come above there.
Yeah, I've always said that the longer that overhead supply, they either have been worn out, or they've probably passed away. Or they've
I never
died.
heard you say that.
That's a little morbid, but the farther you go back, the less that overhead supply is going to mean much.
Yeah. So page 157, Dave had commented that wedging up is bad. Why is the stock wedging up considered a bad sign, but wedging down is okay? So again, if we take a look right here, real quick, I'm just going to comment and then I'll give you this, Dave. So you see here, this is actually coming down. See how it drifts down, right? That's fine. I mean, it looks like it's sideways. It is sideways, but it has a little drift there. That's perfect. That's the optimal situation that you want to see. Dave, why do you want to see that? That drifting down I think you've mentioned this several times during the curriculum, but let's answer this again because there's so many questions about this drifting on this right side, and particularly I think we have to point out that what you're talking about mainly is on the right side of the base and in the pivot.
Yeah, and it you'll see it show up over and over again, that situation. And what it does is it brings the stock in, it gives sellers, uh, sell off a little bit, but not much, and it shouldn't be much. It just gives the stock a chance to kind of rest before it makes before it breaks out and goes. If it's going up at a different angle, if it's wedging up, then it's not giving that stock a chance to rest from the prior move. This had a 10% move from 40 to 44. And then it's natural to get a few people saying, well, I'm a swing trader, I'm going to take some profits, and then it drifts off. You get out the week, any last week holders, and then the stock can break out and go. I can see some spots back in October on this chart where the stock was actually wedging up. Yeah, right around the end of September, early October, mid-October, through the end of October on the Shopify chart, and it wasn't ready. It wasn't breaking out, and it actually broke down and had to spend some more time. So it's just, you'll see this occur over and over again, the drifting. But yeah, Mark, if you could look in October, you'll see some wedging up where the stock goes from 40 up to, that there. And then there's another one from right next to it. Yes, right there. See that? That's not what you want to see before a stock breaks out. You don't want this drifting kind of up looking pattern. You want it to go sideways to down just slightly.
Yeah, not optimally. And I'm going to say something that is really a golden nugget and really most of you will not probably fully get this. You may intellectually, but really it's going to take time before it really sinks in and you understand what it really means. This is all about going through that process of weeding out the supply, wringing out the towel. All right. And as the stock is tightening and the volume is coming in, that is giving you an indication that less and less stock is coming to market, right? This is really important to timing. And this is what Livermore called the line of least resistance, forming the line of least resistance. Why do we get these explosive moves coming out once the stock sets up and we get this VCP and then all of a sudden, wham, the stock comes out and just takes off? Why does that happen? Well, because there's no supply. It's just the law of supply and demand. If you have a little bit of supply and a lot of demand, the price moves. It's that simple with anything. It's not just stocks. It's the law of supply and demand. So this is a way to determine that. Now, each time that you come back to a old high, you get a trap buy. Let me take this out of here, right, and show you. So let's just say you have trapped buyers on, get a little stamp on this side, right? And you have profit takers here. Now the stock, you have bottom fishers here. The stock comes back up here. Now you get these bottom fishers, right? These bottom fishers, where is my tool? The bottom fishers here at a profit, and these people here are at a break even. Now, when that stock starts coming back down, it starts drifting down, these people here start losing their break even. They just sat through a decline and it came back to even. They're like, oh no, not again. I got to get out of here. Right. And they get weeded out. These people here that had profits that ran up starts giving their profit back. And they're like, oh no, I got to get out of here. I'm giving my profit back. I was up, 5.6 points. Now I'm only up 3 points. You see? So now as that happens, the larger the decline, the more pronounced that's going to be. So when you go through that first iteration, you're going to have more pullback. Well, now you weed that out. So now you go to the next iteration. There's less supply. And as you keep going through that same process happens over and over and over again until you're finally in this little tiny pullback. And that allows those last weak holders to get shaken out. Now, let me explain. We, as low risk traders, are weak holders. We're very weak holders. When you're using a stop that's 5 or 6 or 7%, you're a weak holder. A mutual fund is not using a stop at 5%. I can tell you right now. Those are strong. Those are strong holders. Those are people that are buying the stock. They're not going to sell it if it's down just a few percent. So here's the key. All right, I'm going to give you a $1 million sentence. Uh, you want to be the last week holder. That's the goal. That's the goal. I basically have built my entire career and my entire wealth on that concept of being the last, of trying to determine being the very last week holder and getting in that stock at the most perfect time where the supply has been weeded out and I am now in there buying. I'm a week holder, but I'm the last week holder, and I'm not going to, my week hold is not going to get pressured. My stop is not going to get pressured, or at least half the time. I don't even care. If I'm knocked out of the stock, that's fine. As long as when I'm knocked out, when I'm not knocked out, I'm making more than when I get knocked out of the stock. That's the whole idea, is managing the risk reward relationship. But I'm trying to be the last week holder. Again, for those of you who can really truly understand that and appreciate that, that's a multi-million-dollar concept. All right, let me move on. That was a bit of a tangent. Let's see, page 164. So time compression. Markets in recent years have faster paced corrections and reversals. How do we account for that? The correction earlier this year was steep, but relatively short lived. People who waited for time compression or for stocks to consolidate would have lost out on a substantial portion of an up move, as many stocks experience a V-shaped recovery. Okay, so here's the thing. You're going to say, we're going to break all the rules and forget about the concept of supply demand and proper basing and going through those iterations of wringing out the supply because the market came off a V bottom. I understand what you're saying, and that may happen. You may have a situation where you come right off the lows and stocks rip up in a V-shaped fashion. Well, then guess what? I won't be in them at that time. I'll have to wait. I'll have to wait until, and here's a perfect example right here on page 165, which you did not, uh, uh, talk about, but again, here is a perfect example of coming right up the right side. I'm not buying here. All right. I'm not going to break my rules because all of us, I mean, okay, so then do you have any rules? I mean, if we say, or we're going to buy sometimes off of V's and sometimes we're going to wait for a proper VCP setup. No, you're waiting for the VCP setup. Sometimes you'll get a V-shaped market and it might take 6 months or a year before you get a proliferation of correct setups. All right. And you'll have to wait. That's just not your time. All right. So you got to be patient. You have to be disciplined. You're not going to, Livermore said you can beat a horse race, but you can't beat the races. You can't be in the market all the time. There's going to be long periods of time where you're out doing your homework, waiting for the next wave of setups. And that might be during a V-shaped recovery where your stocks are just not meeting your criteria. It's someone else's turn. Like, can someone else have a turn? The value guys have to make money too. They're going to buy off the lows and they're going to buy stocks that you wouldn't touch. And they're going to be selling stocks sometimes when you're buying or even before you're buying because they're in their, estimation, they're overvalued. Again, there's more than one way to skin the cat. The key is for you to become an expert at your way and to be patient and wait for those parameters so you know what to expect under specific conditions and how to operate. If you start trying to, you're going to change and try to adapt to every little thing, I got news for you. You're never going to do well. You're never going to do well because you're going to be a jack of all trades and you're going to be crappy at a whole bunch of things and you're not going to be a master of any one. All right, let's move on here. 165. Oh, so what is November 3rd buyable? November 3rd. Okay, again, good eye right here. Yes, it is. Absolutely. That would be a low cheat. Now, again, like many times, you get the low cheat, it runs up a bit, it runs into that supply, draw the line, right over here. Look, see where the majority of price action is? It's right above this level. That's why it's stalling out and has to go through that iteration. You see again how it's going through another tightening here. That's another ring of the towel, but it's smaller, right? Just like I explained to you, you have trapped buyers, bottom fishers, right? Now the decline is going to be more Now you got less trapped buyers and bottom fishers. It's going to be a little less, and it just gets tighter and tighter until finally the supplies come out of the stock, and now it can move freely. But yes, this is a buy point that you could be buying there. Yeah. Now many of these, just so you realize, grand majority of these examples I was buying at this particular time that I'm showing you. So I'm buying right here. Uh, Now, did I see it here? I may not have, or I may have. I may have seen, I don't remember if I saw the stock here. I may not have been confident enough to buy the low cheat at that time. Maybe the market at the time, I wasn't being so kind to me. I don't know. But sometimes I'll see a whole bunch of low cheats and I'll trade them from here. But again, this is where, where I was buying. All right, let's clear that out. Let me move on here. I think, what time is it here? So what do we start at? 10:30? So we're at an hour and a half, and I got to tell you, I got pages and pages and pages of questions. There's no way we're even getting anywhere near the questions that we have here today. Just hundreds and hundreds and hundreds, and actually we have thousands of questions since the other day. So obviously, we can't get through all those. But let's take a quick break. We'll just take a little break just to rest our brain for a minute. We'll come back here and then we'll move on and do maybe another hour. Okay. Let's take a quick break here. And I don't know if is Bob in the house? Bob probably thought he could go out and
Yeah,
go out to Arby's or something during this time.
yeah, or he's probably on that beach that I was during the most of the program. He's relaxing.
Hold on, let me find them. We didn't really discuss when I was going to. I think I just told him we were going to go through the whole thing, but I think we should take a little rest here. Let's see here.
I'm here, Mark.
Okay, so we're just going to take a little break. If you want to come on the screen here.
Okay.
Just a few minutes.
Okay. Let me do that real quick.
Okay.
Hold on 1 second, everybody.
Real quick too, I want to thank our sponsor, MarketSmith, by Investors Daily. Of course, MarketSmith is the sponsor of the Master Trader Program and has been the sponsor for several years now. And just to point out how humbled I am by that, MarketSmith doesn't sponsor any event other than our event. As a matter of fact, they've never sponsored a single event ever other than O'Neill's internal events. We are the only outside event that they have ever sponsored, and I feel very privileged and honored to be able to say that. So I know Arusha talked about that recently when we did a webinar. So again, and they're giving me the stamp of approval, but I got to tell you, I give them the stamp of approval even bigger because I've been using MarketSmith in some shape or form, whether it was Daily Graphs, going back Daily Graphs Online. Before that, it was Daily Graphs Print. For over 30 years, I've been a client of O'Neill organization, and of course, Dave, is the reason why we have some of these techniques and things in MarketSmith, because he helped develop all this. So again, as I pointed out, I don't get paid to sell subscriptions to MarketSmith, just so you know. So if you sign up for MarketSmith or not, I could care less. But I could tell you right now, it is the product that has everything in one place, and it's the best bang for the buck. There's nothing like it. I feel like it's the category killer. You sort of have to have it to do what I do. And like I said, we're going to have Arusha's from MarketSmith's going to be here on Monday, and then there'll be an offer that if you guys want to, for those of you who haven't used MarketSmith, you can trial it, or you can take whatever special offer they have. All right, we'll come back in just a minute here.
All right, guys. So just going to take a little breather, fresh. Do your jumping jacks or your push-ups, whichever you prefer. I was doing Renee push-ups actually. No, but I'll obviously go bathroom break. Mark is going to continue with the Q&A, get a drink in just a few minutes here. Also, if you are still typing questions, I know a lot of you got them all in there already, but do add the page number at the front of your question. Type in your question. We will be gathering these up for tomorrow's study session. And not study session, but question and answer session that will be continuing tomorrow, 6 p.m. Eastern time. We'll open the room up about 30 minutes beforehand again for testing and preview sound checks. But with that said, let's bear with me 1 second here. Let's just take like another 1 or 2 minutes and we'll get back into the mix. And I'll be back in just a moment.
So show of hands, use your hand raise if you are finding this Q&A helpful. I hope this is illuminating and clarifying some things. And like I said, although we won't be able to answer everybody's questions, we're answering a lot of questions. And I think a lot of questions that are answered, even though they may not be your specific question, are also answering, many questions that we don't even get to. So again, there's so much to this, and I've really boiled this down to a very, very quantifiable, I think as much as we can quantify it, to get to a point where you understand all the right information and that you can analyze this. But again, you need that experience. That experience takes time. So, all right, we're going to start again. And Bob, I want to make sure we got to make sure we're recording this. So you got to start that. I don't think.
Okay, we're good to go.
Yep, we're going to start. Okay, so we're back here for Q&A. Let's start off on page 171. Question is, how can we differentiate between shakeout and a base or VCP failure, since there may be a reset? And then he references page 228 and 234. All right, let's first talk about 171. So Dave, and I think what people have to understand is that to determine a lot of these things, it's after the fact. Like during this decline here, and we undercut this low, we obviously don't know that that's a shakeout, right? We don't know that that's a shakeout at that particular. Actually, you know what? I'm sorry, I'm not sharing.
Yeah.
All right, there we go. That's better that you can actually see it. So page 171. This is a shakeout of this low. Now, we don't know that that's a shakeout until after the fact of it comes ripping back and develops the right side. But we're not looking, this stock would never even come up on my radar over here. As Dave said before, we're screening, we're looking at the right side. So let's just say, we're seeing this somewhere in this area right here, and we see it's tightened up, it's forming a big base. We now can see, oh, there was a nice shakeout here in the low and it came ripping back. We had some institutional support here and now it's tightening up. This is all done in hindsight because we haven't bought yet. So hindsight is fine. It's fine to use hindsight before you buy. That's the whole idea. We're able to analyze this whole left side of the base before we buy on the right side, and the right side is under development. So again, I think I answered it, but Dave, how do we know a shakeout's a shakeout and not a full-blown base failure? At this point, it is a base failure, right? I mean, when we came below the base, it failed, but it came ripping right back. So in hindsight, it's a shakeout.
Yeah, it's just, I don't know. The question is, I mean, yeah, what's the stock done? And it's
Right.
only by looking throughout the whole chart that's a shakeout. You probably wouldn't be in that stock at that point because it's breaking down. But once it sets up again, it's great to go back and see those things, because I love seeing shakeouts because it gets a lot of weak holders out of the stock and helps it to set back up again.
Right.
So
Yeah. And
You
again, we're
don't know
looking.
until you really just go through and analyze the whole thing.
Right. You're analyzing the quality of the setup, and you're looking at the base, and you're looking for shakeout, strengthen it. Do you have to have a shakeout? No, you don't. It might tighten up, and never comes back to that low. We've shown you example after example where you have that, where you don't have these big shakeouts. So, but a shakeout is another element that you can see if it undercuts that low and comes ripping back. Great. That's a great sign. Maybe this is on an earnings announcement or guidance is raised, like we've seen in some of these names. So page 174, and this is just, we talked about waiting for a change in trend, right side development, the setting up the cheat or the load cheat. After a bear market, like in 2008, post March 2009 bottom, when most stocks fell more than 60% from their previous high, how do you start finding new trades? You mentioned earlier you don't trade stocks which have fallen more than 50%. Well, again, you say most stocks, but that's not all stocks. And I can assure you there are stocks that did not go down that much, and stocks that set up, and then stocks that maybe went down that much, but then got into an uptrend and set up a new base. So just because a stock went down 50%, doesn't mean it can't rally and double from there and be in a stage 2 uptrend, and then maybe come down 20% from there and form another base. So I wouldn't, I wouldn't scratch them off the list just because they went down that much previously. It's is the base in the base. If the cup portion or the first correction portion in a VCP is down 70%, yes, that if that's part of the base, then that is definitely a faulty base. It's too deep. And again, if there's not a lot of stocks setting up, then you got to wait. It's that simple. You have to wait. I know everybody wants to be in the market every day and now and under every circumstance, but there's times where you're just going to have to wait. Um, let's see, 180, page 180. And we're trying to do these in chronological order. So we just go through the book, each page. With Zillow, there's a huge volume spike before the pivot point. Is this abnormal due to something unrelated? So I see right here, talking about this big volume spike right here. So again, one volume spike. Sometimes you have rebalancing, like a Russell 2000 rebalancing, the rebalancing index, and a stock is added to it, or something like that. I'm not sure what happened there. Options expiration. There's sometimes that you can have extraneous circumstances, if you will. So
Mark, it could also have been a secondary on the stock. When
Yes.
when I see a spike like that, then I just go and I look up the news, and there's probably some very obvious explanation for it. And especially if it's a 1 day spike and then the stock is set up perfectly, that should be no problem.
Yeah, that's not a problem for me. In that one spike, it looks like it's something. It's an aberration. But again, yeah, I would definitely want to check the news and see what's going on. But then I see the volume comes down. Look at over here on the very right side. Look at the volume. It's virtually the lowest volume in the entire move. I'd say maybe there's one or two other days that you have volume as low as you have on that one day. And I'll just so you can see it a little better right here, right? That's right before stock starts taking off. And that's where you want to see right on that right side. That's where you want to see the volume come in. And if the stock trades, you might not see as big of a vacuum for a number of days if the stock trades a lot of volume, like a big cap name, like a Microsoft. You're not going to get a whole bunch of days of really dry volume. It might be only on one day. On small cap, mid cap names, you might see a significant volume vacuum for a number of days or a week or so, or sometimes weeks. You'll see just almost no volume, and that's very constructive. Um, let's see. So David and Mark mentioned that there is second chance to buy as the stock emerges from the pullback to the pivot. Is this a base on base pattern? Okay, no, it's not. The second buy point is not intuitive for me. And the VCP formed in the prior base. Okay. Um, so now Dave does this a lot more than I do. Dave buys pullbacks as more of a regular part of his strategy. I'm hoping the stock doesn't pull back in the first place. I want the stock just to go and to take off from my buy point. But again, here's a few examples. Let me see if I can find any examples. So here's an example here of Microsoft where I was buying it right here. And remember I told you on the larger cap names, I like to look for the cheats and the low cheats. This is a perfect example of buying a large cap name coming off the lows, the first shot off the lows and the first buyable pivot. And that's where I'm buying right here. Now you see it goes up for a few days. You run into supply on the left side. So that's natural to maybe pull it back here. Now, Dave, maybe you can talk about how you would handle something like this if you saw this and maybe didn't buy it, and you're going to buy it to the pullback to the breakout.
Yeah,
How would you?
let's. Yeah, if I miss that, I'm buying here spot right underneath 110. Then and then I saw it starting to pull back. What I would like to see, and you did get that on that right where that X is you had the stock trade right back down to the pivot point and then close near the high of the day. That's the key. If it pulled back and it closed on the low, I wouldn't be buying it if it was closing on the low, because because that would tell me that, hey, what there's something wrong here, and maybe it's going to break through that base. But the fact that it closed on the high, then that would at least get me started. And then on the next day, when it had a really nice second day, then I would be adding to that position, and I'd be all set. So if you miss it on that first breakout, then lots of times these stocks are giving us a second chance, and sometimes that's even a better place to initiate.
Yeah,
I wouldn't, if I didn't, you don't want to miss that initial buy point, but if you do, this is your second chance in.
Yeah, the pullback is going to be a little trickier and a little harder and more of an expert buy. And I'll tell you why. You may think, well, what's the big deal? It just pulls back to the level and you buy it there. Okay, but you have to assess. And like Dave just said, he just gave you a little nuance that I think a lot of people didn't really fully understand. Talking about the close. All right, so let's just say it pulls back. Let's assume that the breakout point is, I don't know what it is here. Let's just say 108. It comes right back to 108. So you say to yourself, now intraday, that's trading at the low of the day at that particular point. That's right at the low of the day. Not the greatest thing, right? Being at the low of the day. So it's right at the 108. So you say to yourself, well, if I were buying at 108 on the breakout, I'm buying it exactly where I would have been buying it. Yes, but the stock is now coming down and you don't know if it's going to continue to pull back and how much. It may come in and pull back even more and shake out that buy point by enough that it hits your stop. So what I do is if it pulls back to that point and I'm buying it at that point, I then would like to see a strong close. I'd love to see it come back and have that close. And that's what Dave's talking about. He sees that strong close. Great. That's, you start to say, okay, maybe I made a good buy here. It's got support right at the breakout. Now, what if it closes at the low or even goes lower? Now you've bought it right at that breakout. It comes in and you're maybe down 3 points on it, right? Maybe you're down 2 or 3, 4%, hasn't hit your stop yet, but you're down. It closes right on the low. Well, I might actually reduce my position because it didn't get a good close. I might sell the whole thing and just wait to see if it can start turning up. Or I might just stick with my stop and say, okay, I've made a decision, 7%, 8%, whatever it is, and I'm gonna stick with it. It's a judgment call at that time. But this is more of a professional, what I call a pro buy. It takes more skill and more analysis, even intraday, to determine whether the stock's acting right or not. All right, let's see. So page 184. On the cheat, since sometimes you trade a stock which forms a cheat below the 50-day, how do you identify such a stock? Such stocks won't show up in the trend template. Well, yes, they will if you use a trend template without a 50-day, or you can put in your trend template. In MarketSmith, we have a trend template wide or loose where you can put other parameters in there. So what you're looking at, and when it below the 50-day or for a low cheat, I'll allow the stock, if it's really low in the base, I'll allow it to be 8% below the 50-day. Usually what I like to see, though, is the pivot form where when it breaks through the pivot, it actually goes to the 50-day too. So you're actually getting above the 50-day and the low cheat at the same time. Again, you're getting into more of an expert buy. There's more things that you have to look at. There's a few more moving parts. I would suggest that you really try to identify the cheats and the handles first. And then from there, you'll be able to start to see in hindsight the low cheats. And I would really look for the handles and the cheats first. The low cheats are definitely going to be more difficult. And there's a few more, like I said, moving parts. That's how I handle that. Okay, so why does Mark and Dave like an inside day? Well, it's simply just more tightening. Just more tightening. You know, the more tightening you get and the more the stock calms down. And of course, we like the inside day on the right side, the very right side of the base. The more it tightens and the more it goes inside of the previous price action is more indication, especially when the volume's coming in, that supply stopped coming to market. Let's see. Does low cheat entry require volume support? The low cheat, the handle, everything is exactly the same as far as you want to see volume drying up, volume expanding on the breakout. There's no difference. Excuse me, sorry. I got a tickle. There's no difference from the low cheat, the cheat, or the handle as far as the characteristics of the volume that you want to see. It's exactly the same. What time of the day do you usually buy? How would you not get sucked into a false breakout? I don't know why 188 is, let's see. Okay, so maybe you're looking at that breakout that then comes back in and squats. That happens a lot of the time. In some markets, it happens more than others. So, Dave, what is there a specific time that you buy? I mean, I buy at any time except the first like 30 seconds or minute of the day. I know you like to avoid the first 10 or 15 minutes of the day. So, is there any specific times that you're buying or?
No, if a stock is if a stock is going through a buy point, then it doesn't matter if it's at the beginning of the day. I like to see just the first few opening trades, because sometimes you get some weird prints at the opening where the stocks gap up and then they come right back in. I like to see them settle down for the first 10 or 15 minutes. But if it's a perfect buy point, then I've got to at least get something going, at least take a small position. And then if it keeps following through, then I go ahead and add to it. So, but it could be almost any time during the day.
Okay. 191. Richard's referencing from 191 to 193. They're basically the same answer for all these charts, but saying that a couple of these examples seem to have a lot of overhead supply on the left side. Does this matter in the specific pattern? Well, really, not really. If there's not a lot of overhead supply, you're not analyzing that properly. Once again, let's just draw a line across here. So how do you come up with that's a lot of overhead supply? I mean, we're talking about 1, 2, 3, 4, 5, 6 months back. It's only traded above that level just on a few weekly occasions here and there, and the supply is quite a distance back. The majority of the price action is happening right where the pivot is developing. So I wouldn't agree with that. Another one too, as you said, 193. Again, this is a little more because now we're at the low cheat. And again, you see how you're below the 50-day, right? I was just talking about this. You can be below the 50-day, but I don't want to be more than 8%. And then when it breaks out, I'd like to see it preferably clear the 50-day too. And that's exactly what happens here. And then you reference you don't reference 194. Okay, I thought you did. 192. So again, with something like this is Apple, again, there's really no real overhead supply here. When you get to the low cheats, right here, and this is a pause pivot, by the way, right here. Let's see if I can find that'll do it. That's a little pause pivot right there. See, it's just a few days. Now, again, over here, not much supply. And then you might be referencing here because now you have supply on this left side. Yes, when you get to the low cheat, by definition, you're going to have some supply on the left side because it's in the lower part of the base. So that's why it's a little trickier. And again, it's a little there's less of a probability of it working. I probably should have put my phone in the other room. You shut that off.
And Mark, I would add, and we always get to this point where the questions on the low cheat and stuff. For those who are just starting out, who a lot of this is new for you, I would be careful in looking for low cheats, just because
Yep.
some of those you might not analyze it as well as you probably should, especially when you're starting out. And it would be better if you waited until maybe the stock was a little bit higher up in the base.
Yeah, when we first started doing this, and David joined the program years ago, we were at the Master Trader program one day live, and he came over to me on stage and he said, maybe we should drop the low cheat. This is maybe too advanced, and people are not going to get this right. And I thought about it, but I did promise to give everybody everything. So but what I think is important to understand, and what David is saying, is that, like I said, I call these buys expert buys, or when I say it's an expert buy, I just simply mean it there's more moving parts and there's more things to analyze. It takes a little more experience and skill to get it right. And I would agree with Dave. Try to find the cheats and the handles and the bases that are setting up as close as possible to the old highs if you're just starting, and then work your way down. I know people want to do the exact opposite. They want to buy it as low as possible, so they're going to go right to the low cheat. And just like with relative strength, a lot of people will come and say, well, you're looking at stocks in the 90s. Well, they want to find it and they start looking at 80s because they want to find it before it becomes a 90. That's not the way to do this. It's completely backwards. And I know you got to get away from the idea of lower is better. It's not necessarily better. You're not looking for the lowest price. You're looking for the right price. The right price is this when the stock moves as quickly as possible from your buy point and doesn't challenge your stop. That's the right price. All right, let's see. Page 192 looks like there is right side compression on the second base. Why is this not the case? 192. So on the second base, why is it not the case? Let's see. On the right side, on the second base, no, there's no compression on this right side. That is very symmetrical. I mean, does this look like it's running in a V fashion? No, not at all. As a matter of fact, the left side looks much more V-shaped than the right side. This looks V-ish. This actually comes up here, and then drifts over sideways. There's right side development. So I'm not sure why you would think that. Let's see. Let's move on. 195. Let's see. So was it not a low cheat buy immediately after the break of the downtrend line? There's a volume dry up as well. So you're referring to this area right here. And yes, that is a low cheat. Absolutely. And again, so you did have a buy point. You did have a buy point now right here. And then you had the other buy point. Now, again, you may not have seen this at this time, or you may not have the confidence to buy it at that point, and you didn't get the right side development. So in hindsight, you can see that. In real time, that might have been a little tougher buy, but this is definitely a better setup as it fully forms that right side. But absolutely, you're starting to see, and I like to hear this. I like to hear that you guys are starting to see the different floors that the elevator's stopping on. So once you have these various techniques, you'll have a bunch of chances to get on a stock before it comes, or as it's coming out of its base, before it makes that big move. And that's the whole idea of this. So kudos to you. You're getting it. Use overall market conditions when looking at tennis ball action. No, that's just looking at the stock itself. Can we place after hour pre-market orders? 197 above the, hold on, 197 above the pivot. So, I mean, this just is a question for any stock. As far as, I don't trade in the pre-markets too often. The only time I trade in pre-market is when I get a gap on a stock on maybe earnings or even aftermarket, and I want to get out of it right then and there. Maybe I get a big giant gap, and I might try to get out in pre or post market trading. Dave, do you ever trade in pre market or aftermarket?
Pre-market, it's too early. I'm probably still sleeping, but But aftermarket occasionally, but it only if it's a stock that I know very well and I can see that the earnings are really good and I'm maybe adding to the position. But I would say 99% of my trading is during market hours.
Right. So page 199, can you buy a breakout after a national reaction pullback if you missed the original breakout? Netflix around 51. So I think we just covered that, and Dave said, you can buy the stock, on a pullback. Now again, sometimes, with a natural reaction, if I miss a stock, if it's really powerful, I might actually buy it as it starts to turn up from a natural reaction, like even up here where it's extended, but it had a chance to pull back. And I call this a pullback buy, where it comes up off the lows from a natural reaction. Maybe the first, natural reaction and the second natural reaction you can buy that, but you are buying later, and there's more risk and there's less upside because, of course, it's already made a move. So that's just the caveat behind that. Page 199. Okay, we're still on 199. Why not buy first week of July? Okay, so I think this is a good example, Dave. The first week of July, let me show you where that is. And I think this is a good example of wedging. So first week of July is over here. And I would say, I'm not sure the first week, but maybe the second week, but right here is what he's referring to in July. Why not buy here as it's coming up this right side right here? And to me, that just does not have right side development. There's no real pause. It's just not, again, this definitely wouldn't have to look over here.
Yeah, I don't see a handle in there. The stock is coming straight up from, I don't know if that's 36, but it's straight up from that recent low at the beginning of July, and there's no handle. It's not tightening yeah.
Yeah, and then if we look at it over here now, again, get my drawing tool, like right here, I could see myself buying it if it comes out right here. Now, of course, it didn't. See, again, this is why you want to wait for it to break out. If it turned up from here, I could buy it here. Now it's gone through, it's tightened up. Let me give you the VCP count here. So you got here, right? One pull back here. You got another one here. You would have another one here. And then it gets really tight right there. So I could buy it there, right? But it didn't. See, it turned around and it took out that low. So now the count sort of has to restart here. So now the count would be here, right? Pulls back from here to here, and now here to here, and then you get that last little tightening right there. See, and so sometimes a failed pattern is just part of the development of it needing a little more time to fully develop and give you that buy point. So you're living with this stock. You'd probably see this at some point and maybe come on your radar, and then it tightens up and you're saying, okay, well, I'm waiting for this to break out. It doesn't break out, and now it comes off, and now it comes back, starts tightening again, comes on your radar, and now really starts getting ripe. It's like waiting for the banana to get ripe. And I always say, when the banana is ripe enough, the peel like almost just falls off of it, right? A fruit, it gets ripe enough, it's so soft. You want to wait for things to ripen just right, where the trade is not only easy from a standpoint of it working, but it's easy from a standpoint of really having a clear definition and defined risk point, and to see clearly that the stock is acting normal or abnormal based on the volatility that you've seen previously. All right, let me move on here. All right, we talked about drifting up and down. Okay, so why Mark said two natural reactions and he plans to sell some into strength. Well, I didn't say that as a rule. I just said, generally speaking, once you have 2 to 3 natural reactions and the stock makes a move here, okay, we'll just stick with this example. You have 1, 2 natural reactions, moves up a bit more. You after you get through your second or third natural reaction and you get a decent move in the stock, usually what happens is you get a larger pullback that has to undercut a previous low. And it gets more difficult to hold because, first of all, you give up a lot more of your gain, and you start undercutting technical levels that, look scary. And so you have to kind of keep that in mind, that you're going to have more pullback as the stock gets more and more extended. You're more vulnerable. But if I get a decent profit, let's just say, I go through a natural reaction, I go through a full few natural reactions, and then I'm at a 20% profit, and my average gain is 12%. I'm almost 2 times my average gain. I took a risk of 5, 6, 7%. I'm 3 or 4 times my risk, which would be a 3 or 4 R trade. Yeah, I'm probably going to start backstopping or thinking about nailing down some profits there. At least I'm part of my position.
Yeah, I think that's a good point that you made. The farther you're buying from the buy point, from the pivot point, the greater your risk gets. The farther that move gets away from, on this Netflix example, 48, the bigger risk you run in even a short-term correction pulling back 8%, and you're going to be out of the stock. So that's why it's so important to get in at the right spot and not buy an extended, a very extended stock.
Yeah, page 201. Question is, does mid-March have a buy point? Mid-March. So I wouldn't say. I think you're talking about right here. Let me point that out. Hold on one second. So I think you're referring to right there, and I would say yes. I would say yes. I would say even down here is a little low cheat. So yeah, you do have a few buy points. Now, this low cheat here, you see, you would probably be able to go through this pullback and not get stopped out because it just came just a little bit below your purchase price. This one here, you would probably got knocked out on this decline here, and you would have to wait and then re-enter over here. But the answer is yes. That is that's definitely a pivot there. Not sure if I would have bought it, but it is a pivot point. Let's see, bullish signals, confirmations, more up days than down days. Mark's mic went dead while talking about this item, number 2. What did he say? All right, let's go to page 204. So, and Dave, if you want to talk about this, some of the things that we look at, and Dave and I are basically looking for the same things. If there's anything other than this, Dave, you can certainly elaborate. Follow through buying. Once the stock breaks out, we'd love to see multiple days of buying to show that it's not just retail buying. Retail buyers, like most of you here, are going to be, and I'm a retail buyer. I mean, even if you have a $10 or $20 million account, you're a retail buyer. You're not going to move a stock for very long. I can tell you right now. Even though you may be relatively large to most individuals, institutional buying are big institutions that need to buy hundreds of thousands of shares, millions of shares. It takes days to get that position on. So we're looking for those footprints, and those footprints show up as multiple days of buying. That would be your best sign. And even it doesn't have to happen consecutively. It might happen a breakout day, then it rests for a day, and then a few days later comes in. But there's no real, downside in between. More up days than down days. Simply counting the days. This is more for determining whether you want to hold the stock for a bigger move. So you get 5, 6 out of 7 days up, and now it starts pulling back. And instead of taking that 10 or 12% profit that you might be itching to take, it had such a good breakout that now you say, let me go through a pullback and see if I go through a natural reaction and go for a bigger move. And then within that, looking at the closes, you're having more good closes than bad closes. And how quickly is the stock coming back? If it's drifting back and trickles back and then explodes to the upside, that's exactly what you want to see. The opposite would be it trickles up and then comes down real hard. It takes a lot. It's a lot quicker to erase the action versus how long it takes to move the stock up. That would be the opposite of what you want to see. So again, these are all things that you have to look at and make a determination as a whole as whether you're seeing what you need to see, and no better way than just to show you examples.
Yeah, and I would add that you want to see that institutional buying, because if you get all the people together that are listening to this call. We could move the stock for a day, but you get 2, 3, 4, 5 institutions all buying at the same time. And these institutions are not buying $100,000 worth, a few $100,000 worth, or even $10,000 worth. They're buying millions, if not tens or hundreds of millions of dollar volume in the stock. And so it doesn't take one day for them to get positioned. It takes them sometimes weeks. And so the stocks that break out and then just go are the ones that are going to probably be the big leaders, because they're going to be buying them for 2 weeks and that stock's going to get very extended. And I think, I don't know if it was Jesse Livermore, but I've experienced, Mark has experienced this, is that the stocks that you buy and you can't get enough, and because it takes off so fast and it just keeps on going up, are the ones that are probably going to be your biggest winners.
Yeah, some of you who may have read Stock Market Wizards, my interview with Jack Schwager, if you remember, and of course Davidson, the very first Market Wizards, um, he comes into my office, and I was in the middle of buying some shares. I think I was buying 10,000 shares of some stock, and just as he comes in the office, I just had started, buying this stock, and I said to him, I said, I hope I don't get a good fill. And he's like, what do you mean? You don't want to get a good price? I said, no, I'd rather get a little bit of a bad price and have the stock really hard to buy and taking off, as opposed to, it's the all you can eat buffet and they give you all the stock you want and the stock doesn't go anywhere. That shows that there's supply. So when there's no supply and you've done your homework properly, as that stock starts to move, it's going to be very hard to buy. Again, these are things that you're going to have to learn and become good at and have expertise of determining. But right here is a perfect example of showing how this looks on a chart. Look, you come in here, and as you're breaking out, you see each day is getting higher and higher volume, and you're coming out of here really strong, and 7 out of 9 days up. So if you buy a stock coming out of a base and you're 7 out of 9 days up, and you've had all bunch of good closes and volumes real strong, you probably want to try to hold at least a portion of it, maybe sell half of it, hold a portion of it through a pullback, and then see if you can get some tennis ball action. And this pullback is barely pulls back and right back into new high ground. So it's acting great. Now you go through a few of these, then you start looking to nail down a decent profit, maybe scale out of some of it and play some for a bigger move. Or you can free roll it, move your stop up and backstop it, and you've got options. Once you get into this position, you open up yourself with a lot of options, and you're not just all risk anymore. You've got profit. You can take some of that profit. You could finance your risk. We're going to talk about that later in risk management. Let's move on. Page 206. So 206, large volume down day in October. Why ignore this? Is it because it was only one bad sign? Large down day in October. I think we already talked about this, didn't we? Large down day in October. Oh, no, we did not. So this day right here, and I'll just get right there, large down day in October, right? All right. So, well, because the stock's not doing anything wrong. I mean, once you get up here, again, look at how this breaks out, 4 out of 5 days up. And now, yes, it could pull back. You're going to get some selling. Dave, I know this is something that I had to get used to over a number of years. Like when I first started trading and I bought a stock and it went up, and then the first time it pulls back, had a big down day, I get knocked out of it. And then, a few days later, the stock's a new high ground. I'm going, what the heck happened to me there? I got knocked out. And I realized it was a natural reaction. I gave back almost all my profit or a good portion of it. How do we determine here whether this is really a big problem or not? Once the stock breaks out, if you see this big volume come in on a down day.
Well, it's one day. You can't, unless the stock has a huge reversal. I mean, that had a big reversal, but look where it came. I mean, it broke out at 16, or let's say 17, went to 22. That's like a 30% move, and you have one day. Now, if you got multiple days in a row, and your profit is getting smaller and smaller, yes, then I would get worried. But that had one big day of volume, and then it quickly reversed and started back its uptrend. I've actually have found, and you'll see this on some of the strongest stocks, is that they really do not have more than 1 or 2 day reactions as it's going through its uptrend. So one day you just can't blow everything out after one day, because then you'll miss a move that took you all the way to 26. So
Yeah, there is no free lunch. Like if you want to play for a bigger move, you're going to have to hold through pullbacks. I mean,
Right.
otherwise, right, Dave? I mean, there's no, I mean, you're going to have to hold through some pullbacks. Stocks do pull back,
Yeah.
but
Yeah.
I think the question is the big volume. Is the big volume, that volume swell in that one day, is that reason to punt? No, it's not. And if you are, if that's going to spook you, then maybe you should be selling into strength and not even giving yourself a chance to go through that. But no, it's not. And at this point, in this particular situation, if this came all the way back down to the breakout and this day was huge and engulfed the entire move, then that would be something that would be suspicious. So again, you have to look at the situation and gauge it. Gauge it as you're seeing the weight of evidence developing. MVP criteria are for longer campaign holding stocks for bigger moves, or all right. So let's get to that first. 211. So we talked about this MVP criteria. Um, I'm not buying a stock purely because it meets this criteria, and I don't think Dave is either. However, if you own a stock, let's say you buy a stock and then it meets this criteria, that's a stock that you probably should not sell all of. I think you would agree with that, Dave. And also, if you don't own the stock and the stock meets this criteria, it's a stock that you probably should be looking at to buy if it forms a base subsequent to that. Is that essentially, am I uh it's your indicator, Dave. So would that be the way you would apply it?
Oh yeah, if you get that you get that many days in a row, and then you get a proper base. This is where you can make the very very big money in the market, and that's what O'Neill would do. Is that he would just keep on adding money to his big winner, and just looking for additional buy points. But this, when you get this, 12 out of 15 days in a row, and the stock up 20%, and large volume during that run, that's just telling you institutions are getting their initial positions, and this probably has a lot farther to go.
Right. And I should point out when Dave says, someone like O'Neill was buying and adding to the position and keeps, pyramiding the buys, this isn't to say that he's chasing it up and buying it extended or late stage basis. We're talking about when it comes out of that first base and then maybe it forms a second base. As that trend progresses and more bases and the stock gets more and more extended, then you're flipping over and you're selling. We're going to talk about this in selling on how some of these same exact characteristics, counting days, having so many days up in a row. The really neat thing about the sell rules is they basically are the buy rules, just in a different part of the maturation cycle. So you're looking for the same thing, just it's where you apply it. So that's yet to come, and that's a very complex section. So we're not going to talk about that now. But again, yeah, you're so. But Dave, what I was saying was, if you didn't own a stock and then you saw these characteristics, that is a very strong indication that the next base is buyable. And if you did own it, and you saw this, and maybe you have a decent profit, you're starting a new bull market off a bear market. You probably don't want to get rid of your whole position in that stock, right?
No. I mean, maybe you can trim some if it gets very extended, but then I would be looking to buy it back when it finished a brand new base, or I'd be looking to get into it for the first time, if I hadn't previously bought it, because that's telling you, that type of buying with that type of volume is telling you that it's probably going to go a lot farther.
But Dave, someone's asking, what's the definition of a good close?
A good close is usually when the stock is trading on very close to the high, if not the high of the day.
Yeah.
And that's just telling you that people have been buying it all day long and just haven't gotten enough, and they want to keep on buying, but the market they've run out of time, so they're going to have to come back the next day, and that's usually that's a very good sign.
Right. So the more, just think of the midway point as the inflection point. The more you get above the middle of the range, the better it is, and the more you get below it, the worse it is. If you close on the dead low, that would be a very bad close. Let's see. Okay, can you explain low volume out, high volume in? Okay, in more depth. Sure. So that's another one of the bearish signals, right? Low volume out, high volume in. Here's a perfect example where the stock comes out on Now, it could be relatively low volume. It might be a high volume breakout. Maybe the volume is fairly good on the breakout, relative to the base, but then the stock comes back in on higher volume. That would be not the greatest scenario. Now, an even worse scenario would be the breakout is on low volume and it's not even good volume to begin with, and then you have high volume coming in. That's the worst scenario. So again, this is a perfect example of what that means. Simply, the stock has a failure, it comes back in as a pivot failure or a base failure, gets below those respective moving averages on a big swell in volume after a low volume breakout. That's a strike. That's one of the violations that you want to look for. And these violations are after the breakout, soon after the breakout, usually within a few days or a couple weeks after the breakout. This isn't later on as the stock's up, and those are a whole different set of rules that we're going to talk about later. So I guess this next question is exactly what I just said. How more bad closes than good closes, up days, down days, how long after the breakout is this applicable? Generally for the first, through the first natural reaction or a couple natural reactions, the first few days to a couple weeks after the breakout. Then, like I said, as it moves on from there, then we're looking at specific sell rules. 218, how many T's? How many T's is that? Okay, so let's take a look. So that would be, let me get my drawing tool. So you'd have one right here, probably two right here, and then three. That would be a 3T. Let you look at that for a second. All right. Do the 4 lower lows need to be consecutive? When we talk about the 3 lower lows or 3 to 4 lower lows, are they consecutive? Yes, 3 to 4, as you can see right here, consecutive lower lows. That's what lower lows means. They're right in order. 1, 2, 3 lower lows or 4. Now, remember, this is the key. No supportive action on day 3 or 4. If just because you have 3 or 4 lower lows, you don't sell the stock just because of that. If it's on volume, that makes it worse. If it has bad closes, that makes it worse. Right? If there's no supportive action on maybe the 4th day or so, that makes it worse. So you have to gauge the quality of the action, and that's we're just giving you tools. This is like you're building a house. You're not going to use just a saw. You need a hammer, screwdriver. You need all types of tools. We're giving you all the tools. You have to learn how to use and apply them.
And let me add on that no supportive action on day 3 or 4 and 3 to 4 consecutive lower lows. This is just the opposite of what is happening when the stock is breaking out. You want 3 to 4 consecutive days of buying and strong buying. And this is also, if you look at the stock and analyze the stock and go back during the move, you're looking for a change. You're looking to see if there is something different going on in the action of the individual stock. And because if for the last 3 months, every time it corrects, it only has a 2-day correction, and then it goes sideways or it starts moving higher, then that's great. But then all of a sudden you get 3 or 4 days in a row that are consecutive and that are lower lows. That's just showing you change that's occurring. And that's what you're always looking for in the market. You're an observer, you're looking for change, you're looking to see how things are acting differently than they have been in the past.
Yeah. Yeah. Stocks have personalities. Some are hyper, some are calm. You can really see how the stock is acting. And if it's broken, its character. That's another thing that, is purely anecdotal, and you'd have to, make a judgment call on that. But question here about wedging and ledges. Now the ledge, I don't want to get too much on the ledge, but the ledge is a shorting, a situation where I look to short from a ledge. But it's certainly, if a stock breaks down and starts forming a ledge, you have to be really careful. Those are stocks that can really fail miserably. So the question was, do you get concerned when a stock starts hugging a moving average, like here on the 50-day when it wedges? Oh, no, that's not it. I'm sorry. Did we cover that? How to distinguish a ledge more accurately versus a natural pullback? Okay, so a ledge is going to happen below the 50-day, below the 20-day. There's going to be a breakdown, usually below the pivot and a lot of times below the base. So, and even sometimes below the 200-day. So you're going to really have the stock show that the pivot has failed. It's not just A natural reaction is within an uptrend above the pivot point. So this is going to be below. So it's completely in a whole different part of the base, as opposed to where you see here, it's below. All the action is below the pivot and then below the base, where a natural reaction, if I can go back to a natural reaction, see, all this is all above. All this activity is above and everything's in an uptrend. So that's the distinguishing differences there.
Yeah, and Mark, if you go back and you go back to the example you had just before. No, yeah, there. What you're seeing here too is a total change in character. As the stock breaks out, it doesn't hold the breakout, and then it drops quickly. 1, 2, 3 days later, it has a large day down, and then it goes sideways. It can't. It tries for 6 or 7 days, and it can't get back to where it was, previously, and then it breaks again real quickly, and it looks like it does it on some volume, and then it can't recover. That's the change you're starting to see, is that the stock drops fast on bigger volume and can't rally. It's just the opposite of what happened during the uptrend. Now, this was a fast uptrend in Michael Kors, but that's all you're always looking for, is the change in the character of how the stock is acting.
Yeah, as this stock breaks out or attempts to break out right here, what do we want to see? Want to see multiple days of follow through, good closes, bad closes? What happens? It comes out for one day, next day reverses, and then comes all the way back down, has a decent close, but a lot of volatility. And then from there, big down day, and then can't rally. The worst thing a stock can do is break and then not rally. The best thing a stock can do is rally and not pull back much. So you're judging the character. And then, as Dave said, it tries to turn back up and then bang, fails, comes right in. You get a pivot failure. I mean, this is just showing you clear cut right here. You definitely have to be out of the stock. If you haven't sold it, this is clear cut below the 50-day now. And now you just go dead sideways again. You can't rally. And now you break down, you get below the 200-day. And that's where I put it on the short list. I put that on our short list right there. And this stock went down quite a bit from there. Anyway, let's move on. 223. Let's see. Where do we exit? If we enter on the breakout, we would have made around 6% on the first day. When it comes back to the pivot, should we exit on break even? If we let it pull back even further or test our stop loss at 1380, we would have lost 8% ultimately. So, all right. So in this particular, and again, if you had set a stop, let's just say you set a stop of 8%, would you have gotten out before that based on these violations? Yeah, maybe. I probably would have trimmed. This particular name here, I can't remember. I did trade this stock, and I can't remember exactly where I sold it, but I got stopped out of it, obviously. Again, this isn't the best action. Coming out here and then having these two reversals and then not being able to rally and then rolling over right here. This is pretty much just at this number 3 is just showing 3 lower lows. That's the last straw. I mean, that, you're out of it clear cut there if it hasn't already hit your stop. Prior to that, maybe reduce. Maybe reduce. I don't think I would have completely sold it all, and I can't remember what I did on the sell side on this, but that's how to handle that. Let's see here. 229. Let's move to 229. So you did not buy the stock, although the stock met all the criteria. I was wondering why you did not buy the stock while the stock was rising up, although you were late to the party. Okay, well, first of all, I did buy the stock. I bought it right here. I bought, and I don't know if I said that here. I guess I didn't say that, but I did buy it. I bought this stock right here, and I got stopped out either this day or this day. I can't remember. It was one of these days. I got stopped out. Now, this one, I always put this up because it was very painful for me because it reset perfect, what I call a cap pattern, this little tiny mini cheat area, if you will, a cup and handle. And then it breaks out again, and I did not go back in it. And that was the mistake that I made. The mistake I made was not re-entering. This had a pivot failure and then a reset, and then it came out, as you can see, really strong. So I did buy it, got stopped out, didn't re-enter it, and then the stock went on to almost double in just a couple of weeks, a few weeks. Let's see here, page 232. The circle above the 50-day, it looks like a low cheat. It looks similar to a ledge for shorting. How to distinguish? Well, it's not a ledge. You didn't get a real breakdown. It's still trading right about at the 50-day. And again, I can see how you could think that that might be a ledge, but it's definitely a creative, and I told you before, this is a very creative buy, and it's definitely suspect, a little bit suspect. If this doesn't work out right away, I'm gone. But again, the low cheat, when you trade the low cheat, you definitely are adding some risk. And in this particular instance, I see what you're talking about, but it's not a ledge. This didn't really just break down and then walk the plank. Sometimes we say, and just went straight sideways. So still okay. 234. Okay, so this here, I think this might have been the one I was talking about before. Will the breakout on the 27th of February be considered as valid, although there is time compression from early February? There's a mini VCP formed on the 27th of February as it breaks out and takes out the previous high from December. So February 27th, I can't find that exactly on this chart, but let's see what we're talking about here. So February 27th, we're talking about over here. So Dave, again, this is one that I think, I was mentioning before that looks like, it's really wedging up on this right side. And I wouldn't have been buying it. I bought this stock. I bought the stock over here, and I actually saw this stock at this time. I got wind of this stock when it had this big gap up. It was on the company raising guidance, and then I started watching it. So I did not get sucked in to buy it over here. I don't see any reason to buy it over in this section right here. But as it moves over here and tightens up, it's literally as perfect as it can get.
Yeah, I don't like stocks. See, this is the example of a stock coming off the low and going right into new high ground. So many times they have to take a break, they have to rest or even correct a bit. And so even if the stock went sideways, I guess that's 1, 2, 3, 4, 5 days and it looks like it almost broke out, but that's just not enough. The stock has gone from 8 to 12. It's a 50% move. That's where I would say, hey, look, it probably needs more time. And then you just keep your eye on it and look how nicely that thing, how nicely it tightened up and then took off. And this is this example of real tightening. The last 6, let's see, 1, 2, 3, 4, 5, the last 6 days of before the stock broke out was inside that 1 day. So that's showing you very, very tight action before it broke out.
Right. And now you're seeing some of the nuances. Dave is pointing out some of these nuances that we would look for. You see this outside day right here, and then you go inside through the whole pivot and volume comes in very constructive. And these are, again, these are little things. And we're seeing more things in there. There's a real little tiny things, but we can't get so forensic and so microscopic because you're just not at that point yet. You've got to be able to identify these patterns and you'll get to that. You'll get to that even on your own. Again, this stock goes from $8 to $12, making a big move. There's a lot. Remember, we talked about supply, trapped buyers. We talked about bottom fishers are going to have profits. So you're going to need to digest some of that, and you got to go through and let the towel wring itself out. Another question on this particular this chart is asking the third-ish day of January, a low cheat buy. So right here, and I'm going to and yes, it is a low cheat buy right there. And that is a pause pivot. You see there's 1 day. It pauses for one right there. Actually, I have an arrow. Why don't I use the arrow? Well, wouldn't that be easier? Yeah. So right there, that's your pause pivot. So that is a cheat. I hadn't seen the stock then. I wasn't watching it. I wasn't even watching the stock here. This actually, sorry. Now I want the other tool. I wasn't watching the stock here. And this here, if this broke out from there, probably would have bought that if I was watching. That's actually a very nice base being formed. And that was buyable, but it just turned around, went down, and then needed more time. So it depends on where you happen to, see the stock. But yes, that is a low cheat. And I think that's a real good eye that you have there. So is mid-November an IPO buy? We got a lot of questions on this particular chart. So that would be, what was the mid-November? Yeah, mid-November. So I would say the IPO buy is, coming through here. On yes, mid-November. Yes. Yeah, I mean, that's pretty tight. You probably could buy that there. Again, I hadn't been watching it there. It's not the greatest VCP setup, although it did tighten up a bit here on the right side. But yeah, it was buyable there too. They're like, you're seeing all the spots that it's buyable. There's a lot of places where you can trade this, and you could have got a nice move from 8.5 up. And again, I want to point out that these prices are adjusted for splits. Most of them had not traded at the price that you're seeing here. Some of them you're seeing are 50 cents. I'm not buying stocks that are 50 cents, and even these stocks that are $8 or $12, most of the time, we're not buying those price stocks either, but they're adjusted for splits. So this might have been trading at $50 at the time. I don't know if we answered this question. I don't think so. So it's a good time to answer it. Dave, what's the lowest price stock that you'll buy, as far as how low will you go on price? Do you have a cutoff?
I don't have a cutoff, because I'm not gonna be taking big positions in stocks below $5. But if something's $8, $10, and it sets up a nice base, and it's got some, it's got the fundamentals that I look for, then I'll go ahead and buy it. But most of the better price, the real leadership is above 15, 20 and higher. And these days, there's so many stocks that are trading above 100. Very few companies are splitting these days. But the good quality is not trading below $10 a share.
Let me give you a few insights on that. Number one, I categorize basically the price in three categories. One is below $5, or the penny stocks are really the absolute junk pile, which I never trade in at all. Below $5 in particular, and above the $5 to $12 level, I sometimes power plays. There are some situations that I will. I just pointed one out the other day to our MPA members that was low price, but I very rarely trade them, and I'm not going to take a big position usually in them. That's really the lower quality. When you get above $12, even the power plays, I like to be $12 or higher. That's sort of my cutoff for the 99.9% of my trades, and I'd like to see them much higher. But here, let me give you this bit of information, and ease your mind if you think you have to find a penny stock or a low price stock to find a big winning stock. The average price of the biggest winning stocks of the last 100 years, going all the way back to the early 1900s and even the late 1800s, the average price was in the 30s before it made a big move. Before the big move was made, the average price was in the $34 range. So that just tells you right there, that you don't have to be anywhere near those low price stocks. Now, why do we want to stay away from low price stocks? Is there a particular reason that makes sense, based on history, or based on a reasoning around institutional support? Yes. Here's the big problem with a very low price stock. Most institutions can't buy them for a few reasons, but one of the main reasons is that you will have a stocks trading, $3, $4, $5. Usually only a low priced mutual fund can buy those. And so now you just taken away a whole bunch of the firepower that you're trying to get in front of. And so you're eliminating the exact big wave that you're trying to ride. So you want to, and these stocks have to be put on an approved list and go through a committee. A low price stock is going to have a very hard time. It's a junky, it's a junky stock to begin with. And just purely from the fact of going back and looking at history says that it's unnecessary and you're already putting yourself in a lower quality situation and you want to be in high quality situations. All right, let's see. Elaborate on V-shaped bases. Are they more prone to failure? Absolutely. They're much more prone to failure, and the reason is because when they come right up that right side, they're running right into that supply, and they're running into the supply, and they're also putting the bottom fishers at a very quick profit. So you have a convergence of both of those potential sellers, creating supply. I mean, I think we went over this a lot already. Let's see. So that's all the specific questions. We have some general questions. I'm going to try to go through them quickly, but we're going to wrap this up. Okay. So this is a big question from Mark. I'm going to really boil it down. Is it possible to successfully basically employ a hybrid of different strategies? I'm not going to go into the whole dissertation about the strategies, but I would strongly advise against trying to hybrid strategies. It's just unnecessary. If you think that you're gonna hybrid strategies and be able to be in the market every day, all the time, and switch from day trading to swing trading, from swing trading to position or long-term investing, value to growth, it's absurd. It takes a lifetime to master one strategy. But here's the thing, it's unnecessary. If you become a master at any one of those strategies, you'll make tons of money and you'll do great. So why try to be a jack of all trades when you could be a master of something? And specialists get paid well. So be a specialist and stop worrying about that. Again, that's such a scarcity mindset of worrying about you're going to miss something. I got to know everything because in every situation I got to make sure I'm prepared. It's such a scarcity mindset, and it misses the whole point of trading. It's like a baseball player uh, trying to hit every single pitch. No, a baseball player waits for his pitch to come in his strike zone. That's the whole idea. That's how you make a career on that. All right, let me move on. Multiple time frame analysis. Weekly might be failure, but I don't really understand this. But if the weekly is a failure, then the daily is not going to look good. So you're going to want to see all your time frames look good. Okay, a lot of these we already answered, but do we use SMAs or EMAs, exponential moving averages, or simple? I use simple moving averages. I think, Dave, there's no magic moving average, right? That you use. You're just using simple moving averages.
Some on a few I'm using exponential, but that's no, simple moving averages are fine.
Yeah, I use simple moving averages for everything. I don't find any benefit of using one or the other. Any more benefit. Um, let's see. So, how do you screen for low cheat stocks? I assume they will not be part of the 1 month or 5 month trend template. Of course, they will be. They still have to be in an uptrend. A low cheat doesn't mean that again, remember what I said. You got to listen very carefully to what I say. Everything that we talk about in chronological order through this entire workshop builds on what we said previously. Nothing negates what we previously said. So when we say a stock has to be in a stage 2 uptrend, anything we talk about from that point on is in a stage 2 uptrend. It doesn't mean that the stock's not in a stage 2 uptrend. All those are still continuation patterns. So a cheat area is still going to be within a stage 2 uptrend. How do you handle an otherwise perfect stock setup that has all the criteria, but then opens below a pivot due to geopolitical events? If it opens below the pivot, then I guess we don't have a chance to buy it, right? I mean, does it really matter why it happens? You're trying to come up with a reason that you could maybe bypass the rules and say, well, it's a geopolitical event, so we can not worry about that. Look, if the stock was so strong, it would hold up under that geopolitical event or whatever it is. I mean, you just gotta trade the chart. All right, we talked about that. All right, most of these we got to, so I'm just going through them. Do you suggest limit orders for filling in close to the pivot breakout level? More than often than not, I end up buying a lot higher because of lots of emotions that rush in uh, at the live buy point. So, look, you've got to be disciplined. And if you're not, then yes, maybe you should use a limit order so you don't chase it up. If you're putting in a large order, I wouldn't put 10 or 20,000 shares at the market at a stock breaking out of a very quiet pivot. No, no, you could run it up and get hosed on that. If you're buying 500 shares or 1,000, you can use a market order. You're not going to, they're not going to take advantage of you. I know we heard about hunting for stops and all that. Look, you can't account for that. There's these some people think there's this conspiracy and the market makers are going to take the stock down. Okay, yeah, maybe on a thin stock and it's really close to your price, yeah, you might get clipped out and they may take it down a little bit, but they're not moving, they're not manipulating the stock, 5-10%. So again, and I went into a different topic there from hunting for stops, but again, just set the stop, buy the stock at the right price, not too far from the breakout. If you're prone to chasing it up, use a limit order, and don't worry about people hunting for stops. Let's see. All right, I think we're going to wrap it up. Yeah, that's about it. We're wrapping up. We've been going for quite a while here. I think we've exhausted a lot of questions. We're going to do this again tomorrow night I'm not even sure. We may just do a replay of this. That's what we were originally going to do. I'm not sure if we're still going to do it live. We were going to do another question and answer session to accommodate people in different time zones. But what we found is virtually everybody is coming in regardless of where you are, is coming in on the first sessions. We had almost no new unique people coming in on the later sessions. So it almost wasn't even necessary to have a second session. Although I know many of you have commented that you love being able to see it twice. So it is a good thing after all. But as far as, accommodating the different time zones, that hasn't been a much of an issue. So again, but we'll announce that. I guess we're scheduled to come in at 6:00 tomorrow. So there will be something happening tomorrow at 6:00 p.m. Eastern time. So I'm going to wrap it up. Dave, thanks a lot.
Yes.
And we'll talk to you later. We'll be
Okay.
hearing more from Dave, of course, and then we'll be next weekend. We've got 2 days of curriculum. We still have Monday. There's a lot more to go. We're not even close to this being completed here. So get ready for a lot more information. I hope this has been helpful, and I'll talk to you guys later. Bye-bye.
Okay, guys, that will conclude today's question and answer session of the 2020 Master Trader Program with Mark Minervini and David Ryan. We will pick this back up again tomorrow, 6 p.m. Eastern time. We'll open up the room about 30 minutes early for doing some sound checks and connectivity issues, fixes if need be. Although I will say, very impressed with the Zoom, not having any problems or issues with virtually everybody, and that's great to hear. And with that said, we will disconnect now, and we will be providing some updates with regards to, as Mark was just alluding to, any type of replay or some sort of information with those types of questions. I did capture all the questions that was posted in the chat box for today. These will all be compiled and put together for tomorrow. This is what the list will be for Mark to be going through just as he did today. I think we did hit virtually every single question rather that was posed to him, which, as he alluded to in the morning, was hundreds. So I'm very impressed how he was able to get through all of them. We weren't sure we were going to, but enjoy the rest of your day wherever you are around the world. We appreciate you coming out and spending time with us for a few hours, and we'll be back at it tomorrow. Thanks.